Restructuring Roundtable, going over trends and thoughts about where we are and where things are heading. It's moderated again by Renee Burbridge and Weil has been a long-term sponsor of the conference. Renee's been an honoree at the conference a number of times. Most younger bankers who are restructuring. Renee is Weil. Wild's restructuring department. She has served as debtors counsel in several of the largest and most significant Chapter 11 cases in history. She handled the Lehman Brothers, WorldCom, Takata, and she's a real force in the industry. And I'll hand it over to you. Thank you so much for doing this.
Yeah, I'm sitting there. Where do you want to sit?
I just want to get this side.
Hi, good morning, everyone. I'm Renee Burbridge. I will be moderating a thought-provoking panel roundtable discussion on the latest restructuring trends and the outlook for 2024. I'm joined by 5 distinguished experts with decades worth of experience from every corner of the restructuring community, from practicing lawyers to distressed investors, an FA and an investment banker. So we'll have a wide variety of angles. We only have 1 hour, so I won't spend a lot of time on introductions, and you probably know these 5 anyway. But real quick, starting from my immediate left, Mike Schwartz, who's an MD at SVP Strategic Value Partners. We have Jack Butler, who is CEO of Birchley Partners and many years a senior restructuring lawyer. We have Holly Etlin, who's an MD at Alex Partners. We have Sam Maisel, who's a partner at Denton's and the head of their healthcare restructuring practice. And last but not least, we have John Singh from PJT Partners. Okay, so starting with broad thematic trends, there are fewer bankruptcies being filed these days overall, with the majority of transactions being done out of court. A few areas where we are seeing Chapter 11 filings or expect to see them, we'll talk about this, are healthcare, retail, and real estate. I think we'll start with Jack as our senior statesman. Since this conference began 30 years ago, the restructuring world has changed dramatically, perhaps especially so in the last 5 years. Jack, you may have even attended our first panel 30 years ago. So can you talk a little bit about what you see as the most important restructuring trends?
I think 30 years ago, you asked to sort of start the bookends, 30 years ago to now, right? 30 years ago when this conference first began, was really the heyday of rehabilitative restructurings. It was a time when the bankruptcy code had gotten adopted and was on its feet and had legs. People were focused on rehabilitation. Claims trading was just sort of getting started. The alternative lenders were just sort of getting started in terms of alternative asset management. You moved away from club deals among big banks, but you still had a situation where many companies that went into Chapter 11 had equity in their businesses. I don't mean necessarily equity in terms of equity in their assets. So that there were really unsecured creditors committees that had actually someone to represent and actually had a point of view in the transactions, right? And because that sort of bookend was how people thought about out-of-court restructurings, right? You ended up having people getting into a world where there was, you were actively trying to fix companies, and you ended up having companies ending in Chapter 11 for 2, 3, 4 years, right? Trying to use, and trying to actually figure out, a retailer filing 30 years ago would walk in and say, oh, hey, my credit model's not working. Let me try and figure out how to fix it. They'd hire Holly. She would come in and say, okay, let's make these 5 changes to the business. We'll lower the footprint, we'll change the product, we'll do a few other things, and let's see how that works. We got to get through Christmas. We got to get through at least 1 Christmas, maybe 2, to figure this all out, and then we'll figure out the value of the businesses, and then we'll figure out how to distribute everybody. That was kind of how it worked, right? You had to prove yourself if you're a retailer in a Christmas or 2, right? Now, right, you can't get to your first Christmas because the changes in the law have required such that you end up having to be on a very short leash because whoever is traded into your company has to liquidate it out in time before the leases expire, right? And so the world has kind of changed dramatically, right? So I would say, you want to say, what's the biggest change that made in the last 30 years? Is that the goal of rehabilitation is gone. That goal of the bankruptcy code, nobody really files Chapter 11 to rehabilitate businesses. They file Chapter 11 to effectuate transactions. And they do it to effectuate transactions, to do liability management, which we will talk about today, throughout the day. They do it so long until the Supreme Court changes a few rules, they do it in order to try to focus on claims administration, including tort resolutions and things of that kind of thing. So it's a very transactional business now, as it was. I mean, to me, that's you want to say, what's the biggest change? That's the biggest change, right? And then give others to sort of jump in.
Yeah, I mean, what Jack said is exactly right. The industry today, restructuring, and I specialize in the healthcare space, it's all about either closing a hospital or more often selling off the hospital, selling off the facilities. You know, if it's pharma, it is finding a new home for whatever drugs, patents they have available. It is not about reorganizing anymore. That's the current framework of the bankruptcy code, and I do debtor work for full disclosure. I think lenders' attitudes are not conducive to giving people leeway. Maybe the perception is that leeway's been given pre-bankruptcy. By the time you're in bankruptcy, we're done with you. So the focus is entirely on transactions, selling the assets to a new home, and then turning the company, what's left of it, into a bag of money for eventual distribution of revenues.
Yeah, well, the other big change is the degree of leverage. Jack, the other big change that happened in the retail consumer space is lending to liquidation value. That didn't exist 30 years ago. That was about when it started. And when you lend to the liquidation value of a retailer, and then you put a FILO on and they take the extra pieces that, extra value. When the company finally runs out of money, there is nowhere to go. There isn't that equity cushion that you talked about. And so that also precipitates, filing to pull apart, filing for a quick transaction, not necessarily filing to be able to rehabilitate unless you've already cooked your solution and you've got people putting money into the situation.
But Holly, I think you kind of hit a key point, right? I mean, I think a lot of it used to be that when you were filing Chapter 11, it used to be that when you were filing Chapter 11, there were still other options left, right? I think what you're seeing now is that, and for a bunch of reasons, I'm sure we're going to talk about this, but for a bunch of reasons, there are more avenues being exhausted ahead of filing a Chapter 11, and that's new money going in, new lending, even sponsors putting in new equity. But I think it's what you said, Holly. I think at the point that it used to be this concept of, call it, good companies, bad balance sheet, right? That's what you always used to hear. Good companies, bad balance sheet. You go into Chapter 11, you'd be able to fix the balance sheet. You'd be able to do, Holly, whatever operational improvements you needed, and you're going to have that good company on the other side. Good company, bad balance sheet is just so uncommon these days, maybe almost never. We're seeing at the point that a company's going in, it has really been potentially left in a pretty dire strait, and I think that's part of the reason why the use of Chapter 11 has changed.
Yeah, just to pick up on that thread, thematically there are a lot of things that play over the last 15, 20, 30 years, right? Private equity funds are raising capital faster and faster, right? When private equity firms out fundraising, they can't necessarily be putting companies into bankruptcy. We know that thematically is kind of a theme that we've seen in a number of institutions a number of times. I think with the direct lending market, which we will talk about here quite a bit, it's not like the fact that it is necessarily the case that companies don't need to rehabilitate, that companies aren't failing. All those facts still remain, the volume is still there, but to Michael's point, the optionality that companies have, credit document loosening over the last 10 years has afforded, right? More optionality through debt docs. And you had a understanding at the board level of looking at your debt docs in a way in which your fiduciary responsibility to look at these options had actually become a requirement, right? So you're seeing these options play out more and more, and to combine Holly's point, Michael's point, by the time you're actually through that cycle and have played all those options out, if those options haven't given you enough runway to actually turn around the business, right? You're at a point of leverage, and you're at a point of performance in the business if you have no other option but to seek, right? And that's where the bad business, bad balance sheet dynamics have come to play. We've been involved in a lot of those, and that's why the outcomes of Chapter 11 tend to be 363 asset sales, wind downs, et cetera. And you're seeing it kind of sector by sector in the places you would expect. So there's a lot of kind of macro themes in the background from a corporate finance perspective that have kind of led the outcome of Chapter 11 to be what it is. But it's not that Chapter 11 itself has necessarily changed, or that there aren't companies that necessarily need a rehabilitation, just that the options are seeking are different.
Yeah, I'm not sure though that's actually, I mean, it's a chicken and egg problem, right?
Yeah.
Because the reality is that because the rehabilitation goal has gone away, because laws have been changed by special interest groups to facilitate certain outcomes, the reality is that people know that Chapter 11 won't give rehabilitation, therefore equity is going to be wiped out. Unsecured debt is likely to be wiped out. And once you have that, once you understand the back of your head, that's what's going to happen. Then the players outside say, well, then I'm not going there until the last possible moment, right? And so it's a real question about how, and I think you're beginning to see in sort of the Chapter 5 world. And one of the things that some of us who were on the National Bankruptcy Commission would push for was, let's get 90 or 95% of these bankruptcy cases into a Chapter 5 setting, right? Out of the high-cost version of Chapter 11, let's get the middle market to have a chance where there's a chance of rehabilitation, a chance for equity to survive. And all of a sudden, you're seeing now Chapter 5 beginning to show some evidence and some legs in the fact that there can be rehabilitation, at least at some level of marketplace. But in the big cases, in the large transactions, right, all you're really left to, and the thing that people like Holly become huge experts in, are doing RSAs, right? You have to figure out who the stakeholders are. You got to figure out who's going to have the money, right? It's always been the golden rule about bankruptcy. Whoever's got the money rules, figure out what the deal is, and execute it as fast as you can. Because one of the problems the people in this room have, and I would say as an investor, is that bankruptcy is a much worse option today than it was 10 years ago, 20 years ago, 30 years ago, because it's become obscenely expensive. The outcomes are far less predictable, right? People, the whole venue arguments used to be, well, I can go to Delaware, I know what Helen Bailey will do back when there was one judge in Delaware, right? And people say, so I know what will happen. Well, I'll go to Nevada, and I'll go there because I know what that judge in Reno will do. Or I'll go to Texas at one point where there was just a couple judges doing things. It wasn't that people were seeking out, what people were seeking out is predictability of outcome. Because we're in this world and we're investing in things, we need to have some sense of how the rules are going to play. And one of the problems we have right now is that so many people are trading claims, and so many people think that they're masters of the universe. And they're going to look for that one provision in page 123 of some document that's going to give them an edge, which they should do. I'm not complaining about that. But everyone wants to litigate. So it's a massive litigation now, right? And when you create that environment, right, where it's obscenely expensive, you can't figure out what the outcome's going to be. In my opinion, stakeholders in this room are asking judges to call balls and strikes on matters of first impression far too often. And what happens is that what they do is they call balls and strikes, and you don't know what they're going to call. And so you get disparate outcomes in a lot of different places. And on any given important rule to the investment community, there's 5 answers depending upon what happens in different districts around the country.
Yeah, but Jack, isn't it really this recurring theme that frankly has come up, I think, in every one of these conferences? Maybe not in the early days, but certainly for at least the last 10, 15 plus years, is too much money, chasing too few deals, getting more aggressive lending, more aggressive on leverage, and then we see the outcomes of that. I mean, seriously, you lend on a valuation on an IP asset at a valuation of $165 million and in bankruptcy it sold for 23. Those of you who follow me know which one this was. Okay? And this was this past summer. So why are you lending that kind of money? I mean, it's because you're getting pressed for the deal, you know? It's,
That's absolutely right. I mean, we just sold a hospital, we just were in a deal in California, the hospital had $65 million of bond debt and sold for $20 million at fair market auction. But something Jack said a minute ago, I wonder if professionals in the industry don't want to belabor this point, which is the cost of bankruptcy. So if you had a 2-year bankruptcy to restructure, that Holly could run and restructure retail and reduce the footprint, is the cost so burdensome now that we're seeking to do our bankruptcies in 24 hours? And that's a badge of honor because we got it in and out of bankruptcy in 24 hours because the cost of the process, like you said, Jack, has become so high. And I wonder if that doesn't also reduce the options.
So, you know, one of the maybe effects of the cost of bankruptcy being so high is that so many companies are engaging in liability management transactions. And I know there's a few panels today on liability management transactions, so we don't intend to spend a lot of time on it, but it is an important theme. And you know, Fish did a study earlier this year that reported that for liability management transactions that were publicly reported and that were done in the last 10 years, most of them failed, right? So does that mean that liability management is bad? You know, John, do you want to speak to that?
Yeah, look, we'll to Ronnie's point, we'll try to keep this light touch because you're probably here throughout the day and get to some other topics. Look, liability management is the theme of this industry, and it really is hand in hand goes with direct lending as well, right? And what we've seen more and more recently is if you just put yourself in the place of a boardroom, you look at the number of sponsor-owned companies, which is dramatically higher than any one of us have experienced in our careers. And you have debt docs that have been negotiated over the last 5-10 years where loosening from credit standards has been the norm, right? So you go into a boardroom, you lay out the options to a board, you say you can either choose to negotiate with the lenders today, who make you a very difficult position. And by the way, there's a lender dynamic also, which is a CLO bid has been so dramatic and so large that CLO managers are sitting on a bunch of incumbent debt that they don't want to mark, and they're defensively having to deploy capital. There's a lot of dynamics at play when you think about that. And so when you're in a boardroom saying, should we go talk to a group, those groups are forming faster, they're getting into co-ops, and the optionality of what they're willing to give you may not be what is necessary for the business. So as you lay that out to the board, and you say to the board, by the way, your documents have these options, whether it's RP capacity, IP capacity, non-guarantors, unrestricted groups, drop-downs, AR financings, list it all out. And you play it all out and say, based upon your business plan, you have to raise X amount, gives you Y runway to achieve Z, right? It's hard for a board to look at that and say, you know what, let me ignore all that, and let's go talk to the lenders who may not give me a good deal. And the other option is, if we can't get to a deal, is let's not go raise that capital when there's a massive bid in the market to provide that capital, and let's just go file, right? That's a very difficult conversation when there is money out in the market that's willing and prepared to give you capital. And the fundamental question, and this goes to the failure rate and what people are talking about, is there's a bit of a survivorship bias going on, right? You only know what you know, right? And there's a many transactions that are occurring out there that are giving companies runway. The question fundamentally is, are you getting enough runway, right? What is the actual...
Is that C really achievable?
Is it
right?
achievable, correct? And that's, I think that's where the conversation is going to shift more and more, is no board is sitting there saying, this deal is good enough for me, but I'm not going to make it to a reorganization, restructuring, or make it to the other side and actually be able to run this business. That's not the standard. They've been given a business plan, they've been given a pathway, and they're underwriting a deal believing that they're going to get there. I think you're going to start to see more and more scrutiny around the business plan. Hoping to get there. Yeah.
I mean, because it truly is hopeful.
Totally.
When you look at some of these deals.
Yeah. And so again, when you think about that, and this goes to the conversation about Chapter 11, it's going to go into the direct lending conversation, these options are all available. And now you're seeing it not just in sponsor-backed companies, you're now seeing public companies deploy these strategies. And I think that's where we'll talk about 24 themes, but it's hard to ignore that these options are available, and it's hard to ignore that the board, from the fiduciary perspective, has to consider them. And so that's kind of the dynamic that's at play.
Joe, let's face it, people in this room have been chasing the wall of debt for 25 years and have never ever found it. Right? What the reality is that whether it's amend and extend, or it's hope tomorrow, or it's liability management, or whatever you want to call the flavor of the day, because every year we come to a conference, they call it something different, but it's the same basic thing, which is if there's capital available and there's an opportunity, any opportunity to maintain equity and unsecured claim creditors in the deal, right? And for the operation to go on, most boards are exercising what they believe to be their fiduciary responsibilities to go down that pathway.
Correct.
Right? And that's what they're going to end up doing. And so the wall of debt moves forward another year, 2, 3, or 4 years. Right? And I have to say to you, I mean, I just, because everyone says, oh yeah, it's all going to change. The wall of debt is not going to, and you saw the last.
You are seeing some, maybe the wall's cracking a little bit, or maybe that wall's approaching a little bit faster. I think that's definitely true. I can just tell you that, like, internally at SVP, our pipeline, if you look at January 2022 to today, our pipeline, deals that we're following pretty closely, is about 4 times what it was. So there is no question something happening. You're seeing, kind of interest rates where they are, and maybe they come down a little bit, but they're not coming down a lot. Cost of borrowing is just much higher than it used to be. You see kind of lifelines that have been given, either, I'll call it lifelines during COVID that have 25-ish maturities, or you see lifelines that have been given through some of these liability management transactions. And, John, I think to the point that you were making, when boards are looking at this in the boardroom and they're handed a business plan and it looks like they can survive, there's a possibility. The board is not in a good position to go and sit there and judge the likelihood of survival. And I do think that we're talking about, when companies file, they're in bad shape. It's the last resort. It's the last resort. For some of these companies that have gone through some of these liability management transactions, particularly some of the liability management transactions that are, harsher, right? The ones that really kind of put harm one group, put another group ahead, but all of that's ahead of equity. I think you are seeing these things actually have to file, and then to the point that everyone was making, and so that's coming. I think we're going to see a pickup of that. It doesn't mean that there won't still be, let's kick the can farther for all the reasons that have been discussed. Of course there will be, but sometimes, gravity is kind of there eventually for some of these businesses, and when they ultimately fail, they are in maybe far worse shape than they would have been if the liability management transaction didn't happen. But nonetheless, there will still be those Chapter 11 filings because sometimes there really just is no other option.
Yeah, and I think the pandemic actually, I mean, we're all here, no masks, I guess it's over, but certainly in the healthcare space, you see a continuing impact of the pandemic. So all those factors that we normally deal with, inflation, labor costs, and you have this thing, and that, maybe that's why it's different, Jack, because we have this completely unusual additional circumstance where if you could keep moving the ball downfield, avoiding the wall of debt for years, until we had one last straw that breaks the camel's back.
People have always been looking for that straw. I mean, the problem is right now we're convincing ourselves that 8%, 9% interest rates are abnormally high, right? And the reality is that nobody in this room is under the age of maybe 45 has ever managed an agreement, a deal, or put through or underwriting or figured out an Excel spreadsheet with normalized interest rates. Anywhere in, when some of us on this panel actually bought our first house, we charged it. The interest rate on my first mortgage was 18%.
Me too.
Right? So, and so when you talk
I'm
about
much younger. It was more like.
Yeah, I got the curve down.
but the point is that 12%, 10% interest rates, were not obscene at the point in time, 15 and 18%.
Yeah, they were still obscene, but they were common.
Well, the businesses just weren't underwritten to kind of support that interest.
Correct.
The interest wasn't hedged, and that's the problem that we're having now. People are kind of lending in at these even higher rates, with the idea that as long as the business plan goes like this, they can cover.
But when your returns are higher, Michael, don't you then you feel less pressure to take higher risk to get that higher return when the base return is better, or not?
Well, so look, I mean, I think everyone who's and one of the things that we obviously look at is lending new money into businesses now, right, including some of these situations. So, but we try to be, when we're lending new money into a situation, we really are looking, the board may not have to sit there and kind of do the math and figure out, does this business actually have a chance of success? But we do, right? So if we're lending new money into a situation, we're very focused on, is this business plan believable or not? With the cost of interest as it is, et cetera, is this business plan actually believable? Are we actually going to get par? Or is this, if this is a living prayer for us, it's not something that we want to actually look at and invest in. That, maybe that's different than others, but that is without question the way that we look at it.
Okay, very lively discussion as we hoped for. So we've hinted at a discussion on direct lending. So why don't we talk about that? Maybe Mike, you can start to talk a little bit about what direct lending is and how it's changed the industry. And I know John has interesting comments to make on that as well.
Yeah, no, absolutely. So I think, by the way, it's a lot of what we've been talking about now, and it's a lot of what, John said about direct lending and liability management, going hand in hand. I think what we've seen is tools being available that didn't exist before. So this is the proverbial, the documents, the holes in the document, and how all of that is going to work. You've seen, obviously all of the drop-down financings, and there used to be, and not just drop-down financings, but layering transactions. You've seen the, kind of the new term of art is the double dip. I think those are still, kind of untested. And some people view and we'll leave the descriptions, I think, to some of the other panels, but some people view these double dips as actually being, I'll call it, less aggressive than some of the other type of LME transactions that were done. So but you're seeing, kind of all of those tools available in the toolbox, all to kind of keep companies from needing to file bankruptcy. And you're seeing, as people said, just more money, more capital chasing it than ever before. What I think it's done is really an interesting mix, and I think it's an interesting time for the market as a result of it. I think there are a lot of companies where this is a lifeline, and a needed lifeline, and a helpful lifeline. I think about, for example, there are a bunch of retail businesses and manufacturing businesses that we've looked at recently, that we've been involved in, that have a COVID pull forward. Real Pros was a deal that we were involved in that I think is a great example of this. They had a COVID pull forward. A lot of people were putting new wheels on their cars during COVID, when it was impossible to buy a new car. They would put new wheels on their car, kind of improve the look of it. In a post-COVID world, all of a sudden that drops off. There had been a lot of purchasing. Stores had this kind of glut of wheels sitting on the shelves, and all of a sudden people aren't so interested in doing it now. They're getting that new car, et cetera, et cetera. But as things normalize, which is only happening now, you're actually seeing things normalize in the business too. You can sit there and do a good job underwriting that business plan and saying they don't necessarily have maturity issues, they don't have over-leveraging issues, they have a liquidity problem, they can get some new liquidity, they can potentially get some relief on maturity, and this business has a real reason to survive. And I think this direct lending is just a great opportunity for businesses that can actually pull through. You see other situations where we've been involved, where American Vision, I think, is an example that everybody knows, where they raised something like 1.3, 1.4 billion or something, probably around that a little bit, and yet the company files probably 8 months after the second LME transaction is done. So look, you just are kind of seeing the two ends of the spectrum. And I don't think we've really sorted out exactly, wherein lies the right answer for this.
And Michael, what's interesting about that is a lot of those direct lending solutions are dealing with systemic shocks to businesses, or the business still look pretty good. And a lot of those systemic shocks translate into working capital dynamics. You've seen that with COVID. You've seen that with no surprise billing act for a lot of companies. you've seen a lot of those, those underlying themes translate into working capital stretch, and that's really where you're looking for direct lending to come in as a primary sweet spot when you believe that there's a normalization that occurs. Envision's an example of something where the normalization took way too long. You're actually seeing thematically, you're starting to see that those underlying trends are actually starting to shift, but the capital that was being raised was just not sufficient in that scenario, right? And so I think this is a theme that you're going to see, but just to give people a sense for like direct lending as kind of a space, and Holly has some great thoughts which talk about at the back end of this as to where we think it's necessarily going. But just to give you a sense for like just the size and scale of this market, right? Sitting here today, you have $1.5 trillion of high yield and leverage, and $1.5 trillion of leverage loans. You have $1.5 trillion of direct lending. Like this is a legitimate 33% of the market when you think about just the size and scale of the market, right? You have $30 billion raised just through the 9 months of 2023. If you think about 2023 in totality, it'll fall just short from deployment of 2022. And people's belief is 2024 will only be higher than that. You're also seeing a evolution of direct lending institutions that are now ending up back at the big money center banks. You're seeing hedge funds partnering up with Wells Fargo. You see JP Morgan looking for a partner. You look at Citi coming out and saying, we need to find a partner. You've had Brookfield partner up with another firm. So you're starting to see this evolution of the market where it's no longer can be ignored by the big money center banks. And you're just going to see more and more flows come into the space, which will require, right, direct lending to evolve. And I think we'll talk a little bit about that a little later on. Holly can cover it as well. But it just gives you a sense for scale and size. These are not one-off transactions. And what's fascinating about it is that typically with high yield or leverage loans, you have a bank in-house, it's a money center bank that's giving you a bunch of solutions to a corporate board and then trying to go price it. What you're seeing with direct lending is sophisticated single entity counterparties reverse inquiry in with structures and capital, right? That is predominantly happening to all of us. We get term sheets left and right from blue chip, funds that are saying, here's a check, here's what the structure looks like, we understand your business, and you have a pretty sophisticated counterparty that's trying to let you give you capital. And that results in a good level of engagement. So it's just becoming a space that is unavoidable, can't be ignored, and frankly, I think it's probably good, but to Jack's point, is another solution to the maturity wall. And so this is just going to push everything out further.
And with everything in this business, guess what's going to happen? Direct lending has tripled since 2020. It's forecast by 27 now to be, approaching 3 trillion. And so what's likely to happen with this market? First of all, you're going to start to see, instead of single entity deals, you're going to start to see club deals. So now we're back to complexity again, right? With multiple parties, multiple interests, all of that. You're also, S&P predicts, now this is in S&P's interest, but they predict that people who put money into these funds are going to start asking for ratings. So now you're back to rated debt and the complexities that go with that. So, as with any trend that we've seen, where, you have large sums of money flowing into something, the people who are, early do very well, and then the business evolves and matures, and it starts to look a lot more like some of the more conventional lending groups that we see today.
Are you suggesting that in a few years we'll be talking about direct lending the way we're talking about SPACs?
More like term lender groups, like where you have 15 participants and you're trying to get enough of a group together to do an RSA.
Yeah, I meant more in the sense of it's a wave that will pass.
I don't think so. I mean, the desire for non-regulated money and the ability to get around the regulated financial institution world is really important for a company because there are very significant restrictions as to what you can get when you're just dealing with a money center bank.
Right? Yeah, I think what you are going to see, and you're seeing this even in LME, right, is as institutions and the bid gets larger and larger, the capital is getting friendlier and friendlier. Right? Aggressive creditor up tiers have somewhat toned down more recent, and you're starting to see big institutions that have done that in the past very much say, we don't want to do that. We want everyone to participate to a deal. Direct lending is going to have a very similar dynamic, which is more and more bids come out. I mean, the largest direct lending deal that has been done, just to give you a sense, is $6.2 billion refinancing. I can't imagine one institution wants to keep all that risk on one balance sheet.
That's, by the way, that's exactly what we see happening too, is that the direct lending was initially pretty small, right? $100 million to $300 million checks. They're in the billions now, right? And the minute you do that, you see exactly all the complications that you were just talking about, right? As far as, you know, kind of group dynamics, et cetera. You also see, obviously, the capital is without question getting friendlier. That's not just, I think, in the direct lending market. It's also tied to the equity market, where even those have become, you know, pretty competitive. So, John, I'm sure you are seeing term sheets coming in, not just for what I'll call regular way refinancings and regular way direct lendings, but I have no doubt you're seeing them coming in for LME transactions as well.
Absolutely. And the LME deals, there's a couple of interesting dynamics at play with that, which again goes to direct lending, is you initially had this point in time in the market, where it was a nascent market, where there really wasn't a good clearing bid, which allowed you to push the envelope on both how aggressive it could get, the pricing it could get, the loan to values it could do, all that stuff. All those dynamics are narrowing because the bid ask has gotten so, the volume has increased so dramatically. And also you're starting to see is institutions that provide this capital, they themselves have diversified. Some have BDCs, some have regulated entities, and when they think about their LPs and GPs, they also think about, we don't want to necessarily do a transaction to a lender group that also is maybe an LP GP in our fund. And so you're starting to see behaviors of institutions say, okay, let's do an LME deal, but let's make sure it's open to everyone. Or let's make sure like everyone has a look at it with a smaller holdback. So you're starting to see dynamics that are shifting more and more towards inclusive capital. And you're also starting to see institutions that you typically would not want to do LME transactions step back and say, well, maybe I can do this in a more creative, thoughtful, constructive way with a lender group, and it may be an LME deal, and it may structure it to get a better transaction, but I want it to be friendly.
The new thing about direct lending, right, is it is more, by definition, more complex. What I mean by that is, like, when you're looking at putting something in, you're not saying, oh, I need to be a senior lender, and I'm going to be a senior secured piece, I'm going to take the first lien on the property, and I'm going to have these come with that.
We don't mind that, though.
But you typically end up, the opportunities you have, typically end up saying, I've got to be more innovative than that, I've got to be more creative than that, I've got to be more friendly than that, and so you're making really a structured equity investment, right? You're all over the capital structure, right?
Yeah, absolutely.
Your preferred, but you don't know it.
Right, that's what I'm saying. And that complexity, which is being built into these transactions, right? And, which is not subject to sort of traditional claims trading, right? Because when you're sitting inside of a set of funds, and I've got 7 funds, 3 BDCs, and I've taken some capital from there, some capital, you're just trying to manage your own internal economics and fiduciary responsibilities of your own investors, right? All of that's going to have to play out in the wash when those things get in trouble, right? And that's really that's how I was talking about. That's the next step, right? What happens when that? And by the way, John's not wrong. It's a third, folks, of the capital out there right now, at least, and it's going to get bigger. It's not going away, right? And so it's these issues that I was talking about are the real things that are going to happen in the next 2, 3, 4, 5 years.
Well, I think sponsors have also gotten very sophisticated in the way that they think about it. So, and by the way, and I think, lenders have gotten sophisticated in response to that. So when we look at some of these deals, sometimes we're in the structure, sometimes we're an existing debt holder, sometimes, it's new money, we're not involved in the situation. When we look at these deals, you kind of sit there and you say, all right, the sponsor's smart. They're going to generally go and pit the existing creditors in a competitive process against some type of outside kind of third parties. It's all the term sheets that John's seen kind of come in. And one of the quickest things you have to figure out, regardless of which side you're on, is what is the sponsor looking for here? Is it just liquidity? Are they looking for discount because they're really over-levered? Or are they looking to, are they looking for some type of A&E because they see that maturity wall that inevitably is going to get pushed out, but they need to figure out how to do? Are they looking for a combination? And what we'll tend to do as we're thinking about what our proposal is going to be, again, regardless of which side we're on, we might come in for the first time, or are we already in the existing structure, is figuring out what does the sponsor need? how can we figure out a proposal that's going to work for us and is going to give them exactly what they're looking for? And that's why, kind of not all of these LME transactions are created equal. Sometimes it doesn't really matter what the documents say we can and can't do. There are a lot of things that a sponsor isn't going to do because it's not going to help them. And so I think what you've seen is, it used to be when you're doing this analysis, everybody would run to the documents, especially if you're in the existing structure, and say, oh no, what can they do? That was the analysis. What can they do? Now it's, they can do almost anything. Maybe you know that already. But what are they going to do? Why are they going to do it? John pointed out, if there's a capital raise going on, what's that going to be for them? What are they willing to kind of put themselves out there? Do they want to do these aggressive deals, or do they not want to do these aggressive deals? I think they're still on their own knees. What do they need as far as new liquidity, as far as maturity wall kicking out? What is it exactly? And that's all become part of our analysis as we're thinking about how we create term sheets and how we respond to this.
Let me ask you a question, because the market's not homogeneous, right? I mean, one of the things that's phenomenal the last sort of 18 months has been that some of the funds who have 10, 20, 30, 40, $50 billion in assets, they're managing those kinds of assets, have done a couple of things. They have stepped back from private lending, private investment. They've said, I can make in these markets, a lot more just investing in public things and have more liquidity, right? That, I don't know how much longer it's going to be, but I'm curious if you've seen that trend, and you've seen also a trend that a lot of folks who've done very well in this area, who advertise themselves as generalists, right? I can look at 17 industries, have come to the conclusion that they actually need to bring on segment experts in order to be able to compete with some of the other places that have it. So those two trends, I'm just wondering, as you see in the marketplace, how's that affecting direct lending? Those two things, because they're significant, at least short-term events.
Where I've seen them, just me personally, where I've seen the most effect is that I think the market's grown so much that what you really see is funds that used to do kind of a more broader swath of things, including buying debt on the secondary market, almost repurposing themselves and focusing on this direct lending because that's where they see the market going. And there's a little bit of the, call it chicken and egg, right? It's more, or maybe say it's a cycle, right? So it's in itself perpetuating. So what you're seeing now is less and less people actually out there in the market really looking to go through purchasing secondary debt and go through restructuring transactions. That's what makes sense for business. More and more people focused on let's put our capital into direct lending. That's where I've seen.
Yeah, but Jack, I mean, in response to the question about are you seeing people bringing in specialists by industry? Certainly in the healthcare space, no rational human being is lending into healthcare without a specialist anymore. It's just so heavily regulated. The return on investments are so difficult, and the market forces are different from retail. So it's not WeWork, right? Even though if you're running a hospital, occupancy matters. But yeah, certainly in certain industries, healthcare, I think, is particularly vulnerable to this. If you're investing in it without a specialist who understands the space, you might as well just burn your money in the courtyard.
Yeah, Mike, well, just to go back to one of your comments about, and Jack's comment about, was you're seeing a pullback, right, just given where yield and investment opportunities are. There's another dynamic at play that I think is keeping people in the direct lending space. And that is the faster direct lending is getting into companies to provide solutions well before significant stress. And that's partly due to the bank lending market, where yields are at, where rates are at, and competitive BDC structures that can give pretty attractive capital, and the success of third-party capital against incumbent capital structures. That is a huge dynamic that is playing out right now. You're starting to see third-party capital successfully deploy direct lending capital into capital structures where the cap stack itself is not providing the solution, or has not even been approached because you've been there so quickly. So that is creating another dynamic of just this bid for direct lending because the space is just so large.
Yeah, but John, just to be clear, is it replacing or just adding debt?
It depends. Some of them are additive. Some of them are paying down revolvers because revolvers want to get paid down a little bit. So it's a combination of things. But
it's not additive.
it's additive because they are looking for additional liquidity, and they want the liquidity on balance sheet.
So just staying true to our theme of just touching on different topics, I think we could talk about this all day. Let's turn a little bit to the industries where we expect to see action. We're seeing more action than others and expect to see maybe more Chapter 11. Holly, you spent most of your career on retail. Do you want to talk a little bit about the big issues we're seeing in retail cases or how the current economic situation is impacting the retail industry?
Oh, absolutely. Retail is the gift that keeps on giving. That's why I do it. I actually fundamentally believe that retail is an extraordinary business, and when it's successful, it's great. But so what we're going to see in this coming year, we're going to see several high-profile liquidations of things that have been sitting out there. They're leveraged. We're going to see a continued fallout in sort of the off-price space, the consolidation there, department store, or sort of pseudo department store space. We're going to see several shakeouts there, and we're going to see a lot of stuff in the very small space, the direct-to-consumer space. Direct-to-consumer companies have proliferated in the private equity world over the past 5 years. That trend really started well before COVID. It accelerated during COVID. These are companies that may or may not have a store base. They generally have a brand. They're vertically integrated. There's going to be a lot of consolidation and move also in that space. It's not that they don't, as business concepts, survive, but there's way too many of them. And there's way too many Me-Too's, and the consumer just doesn't have time or energy for that. Consumer spending, as we're seeing right now in the holiday season, is not terrible. The retailers that we work with are, coming in right at or slightly ahead of their sales plans. There will be some outliers who are going to really miss it, but it's not like, oh my goodness, we're heading into a recession, the consumer's going to pull way back, etc. There is going to be continual caution, but frankly, getting interest rates back to a more normalized environment kind of helps, sort through the deck. Winnow out that which has been propped up, which probably shouldn't be.
What people say and what people do, it seems to be different these days when it comes to consumer sentiment.
Yeah, it's very interesting. People say they're concerned, but then they're still out spending. Obviously, consumer credit is really at record levels, etc. But we'll continue to see this winnowing of the weaker, and there's always churn in the retail space. I mean, think of boutique retailers that were around 15 years ago that aren't here today. It's just for every 5 or 6 concepts that start, one survives 10 plus years. So you just see that. Part of this also is, and we saw this in Bed Bath & Beyond, I think the ABLs themselves, because we go back to ABLs lending, they're going to get more cautious. They saw in Bed Bath & Beyond what happens when somebody doesn't buy the inventory that they tell you they're going to buy for the Christmas season, how your net orderly liquidation value, which is the basis of your advance rate on your loan, that's how you're going to recover, how that falls precipitously when the company finds out it's dramatically out of stock. I mean, we saw that. We have a FILO lender that's still looking for the recovery there, and that hasn't happened in retail in a long time except in fraud cases. So it was a real wake-up call for those regulated style lenders and formulaic lenders to really take a hard look and be a little bit more conservative.
Yeah, Holly, 5 years ago, we were all, I think 5, maybe 10 years ago, talking about the impact of the internet destroying retail because everyone would just shop from home. And certainly during the pandemic, we saw, even dinosaurs like myself got more familiar with buying things on the internet. How does that affect retail, bricks and mortar stores? Is that competition sort of leveling out now?
Well, everybody during the pandemic took multiple years step forward in their e-commerce penetration of the customer base. The problem is e-commerce is more expensive because you've got shipping costs, etc. For example, if you're selling things on Amazon today, the all-in pricing from Amazon 3-4 years ago was 35% for you. And that's before your cost of sales. Now they're up to 40. So if you're, and that's reflective of the fulfillment costs, the last mile costs, the getting this product to the consumer. It is inherently several points more expensive. So it puts pressure on the rest of your expense structure to try to make up for that. It is inherently true that selling the same product in the store nets you more money, net of the cost of operating that store and the payroll and everything, than it does if that consumer buys that same product online. And that continues to be true. Everybody is really pressing. If you look at the big supply chain projects that have gone on this year, every retailer is trying to squeeze costs out of their supply chain so that they can be in that place where they don't have such a large differential between store-based product sales, et cetera, because you have to be in e-commerce today to survive with that customer. The customer has to have the option.
Sam, do you want to spend a few minutes talking about healthcare, which is an industry that a lot of us are looking at as a source of business or investment opportunities in the coming year?
Sure. I mean, I know we're wrapping up, so I'll be brief, but like Holly, I feel like the healthcare industry is the gift that just keeps giving. I mean, the industry, first of all, remember, we're talking about 20% of the gross domestic product in the United States is tied up in healthcare in some form or another, right? And it's simply impossible to talk about the healthcare industry, unless you had like a day-long program, because it covers everything from what we think of as patient-facing providers like hospitals, skilled nursing facilities, ambulatory surgical centers. Think of how you get healthcare provided. But then it also includes transportation, like ambulance services, which you talk about the No Surprises Act has been just hammered by that federal legislation. But it also includes huge investments in artificial intelligence now, and huge investments in electronics, because over the last 10 years, the entire industry is converting, with great difficulty, to electronic medical records, electronic healthcare. That's created cyber risks that didn't exist, that we didn't talk about 10 years ago, because every hospital in America now has to worry about being attacked by somebody sitting in a basement in, I don't know, St. Petersburg, and shutting a hospital down, because it isn't just their ability to bill that's electronic, it isn't just the ability to access records that's electronic, but it's also that medications are delivered electronically now. So that hacker in St. Petersburg can not only affect the ability to bill, not only affect the ability to treat patients, but can change how medications are delivered to patients in beds. These risks are enormous, and so this is another area of huge investments in the United States and all across the electronics. And then you've got what we like to think of as, just what's the definition of insanity? It's doing the same thing over and over again, expecting a different result. And we think of physician roll-ups as in that model. And so now you're seeing
Or dental roll-ups.
Or dental roll-ups.
Yeah.
We've gone through now 3 cycles in the 3 decades I've been doing this. Physician roll-ups, dental roll-ups failing because, in fact, you can't herd cats.
Sorry, Sam. I'm told we only have a couple more minutes.
Yeah. So where's the investment potential? I mean, first of all, like Jack said, this is an area where you really have to understand the regulatory framework, because you can't invest in provider-facing healthcare unless you understand the controls on return on investment, because Medicare and Medicaid are the 800-pound gorillas in paying for healthcare stays. And if that's right, and they tell you what they will pay for services, you can have a business plan, but if they decide, for example, with the No Surprises Act, that they're going to deny you the ability to pass on charges which the health plan doesn't pay, all of a sudden your business plan is basically a worthless piece of paper. The huge increase now in antitrust enforcement by the federal government is, this is a very diverse, still not centralized business, hospitals, skilled nursing facilities, even worse. And antitrust enforcement has made mergers and acquisitions in the space even harder over the last few years. Continuing regulatory pressures like California just increased the minimum wage only for the healthcare industry to $25 an hour. I mean, it's great for workers, but if you're running a hospital and you have no way to pass on those additional costs, that's a huge problem. And now the federal government's passing legislation to increase staffing requirements at skilled nursing facilities where they already have increasing labor costs and can't pass those on. I mean, the industry is the definition of distress. And so the investments there are, the opportunities are growing. The difficulties are in figuring out what investments are going to make sense in, for direct investment, for example.
So let's close with maybe 30 seconds from each panelist about a trend they expect to see, something they expect to see going into 2024. We'll start with Jack.
Okay. Well, I'm less confident than everybody else in the room that interest rates are going to go down as soon as. I know that's the popular hope. I think it's a hope again. I think it's a popular hope as opposed to likely to occur. I just don't see the dynamics. Absent some of the additional event risk out there that the Fed can hang to and say, okay, because of that, we're going to do this. And so as a result of that, I think there's going to be continued pressure on companies, on cash flow, on liquidity, and I think that I don't think that has been that I think is going to be, in my view, the dominant theme over the next year.
Right.
So I agree with Jack. I think that you are going to see kind of more activity next year. I also think that actually Europe is going to be pretty interesting to watch for those people who do. A lot of restructuring laws just changed over there over the last probably few years. These laws allow something that looks much more like Chapter 11 style debt for equity restructuring than was ever allowed before. We were just involved in, I think the first one to go through called Celsa in Spain. Almost every EU country has changed their law, plus the UK. They have a restructuring plan now that allows for debt for equity restructurings. All of those jurisdictions are much faster, much less expensive than Chapter 11. I think there's a question about certainty. We were all talking before about going to different judges because of kind of certainty of outcome. I don't know that people have that level of confidence yet, but as that level of confidence builds and as you see more and more reps happening over in the new European regimes, I think it'll be really interesting to see what happens to trends, not just for European companies that have historically avoided these types of bankruptcies, but even call it worldwide, are there going to be U.S. companies that would be interested in taking kind of utilizing one of these restructuring regimes instead of a more expensive Chapter 11 process? I think those are all things that kind of
Different kind of form shopping.
Exactly.
Overseas. John, how about you?
Just some sectors that I think thematically will remain relevant into 24. I think healthcare will continue for a while. Consumer will be another space. Telecom we didn't really talk about, but obviously it's very, very topical. I think you're going to see a lot of opportunities there, potential stress there as well. Where are we seeing it? And then I'd say another sector that I think people have been waiting on probably 3 to 5 years, which is the office real estate space. So I think that's another sector that we're starting to see cracks in. The problem there is the cost of capital they're at, the demands they have from a funding perspective, a dividend perspective. The optionality is quite limited. So it'll be interesting to see how that sector actually plays out, whether we start seeing some volume next year.
I think we have a panel later on today about real estate restructurings. How about you, Holly?
We're busy. And so, what we're looking at in 24 is a steady stream. We're not going to see these gigantic peaks, like remember the peak in the recession, where restructurings went through the roof, but we are dramatically busier with both in-court and out-of-court restructurings of businesses with debt maturities and liquidity issues now than we were last year this time, and we're expecting that to continue at a fairly steady pace, if not slightly increased during 24 into 25, which is where a lot of those maturities sit.
Higher for longer, as we've been talking about that term.
Yeah.
And the numbers play that out. The number of mega Chapter 11 cases filed in the first half of 2023 equal the total number of mega cases filed in all of 2022. And people see the trend that's last but not least, Sam.
Yeah, I think certainly in the healthcare space, the distress is just going to continue to grow. There is no sign of lessening interest in additional regulatory impediments to successful businesses. The industry has not recovered patient volumes from the pandemic, but at the same time struggling with increased labor costs, labor shortages, inflation, which they can't pass on because their contracts are all long-term. It is an industry where I think we're just going to see tremendous turmoil in 2024. Basically across certainly all provider-facing segments of the industry, but also you're going to see the ripple effect on ambulance services, Cerner, Epic, the big providers of electronic medical records are going to suffer. You're just going to see a ripple from that.
Thank you, Sam, and thank you, panelists. We've successfully covered a wide